Little change this morning, just 0.3% away from all-time highs. 30 minutes ago into the start of your cash equity trade, I'm Dani Berger. Matt Miller is off today. Bloomberg Open Interest starts right now. Coming up on the show, earnings season kicks into high gear. Corporate America provides an upbeat picture in the absence of wider economic data. Meanwhile, investors weigh signs of easing trade tensions as President Trump predicts a fair deal with China. And CoreWeave tells Bloomberg it won't raise its bid for Core Scientific despite opposition from major shareholders. The overall stock market might be flat, but we had some earnings shaking things up some morning. Some of the stocks we are watching, General Electric up more than 2.5%, raising its full-year outlook for a second consecutive quarter due to strong air travel demand. Coca-Cola, those are up 2.6%. Shares and sales topped estimates, and a sign that consumers are buying drinks at higher prices, and apparently Mexican Coca-Cola. GM, meanwhile, raised its full-year outlook on better-than-expected pickup truck sales and tariff relief. Those shares up a whopping 10.8%. General Motors CFO Paul Jacobson spoke on the company's strong quarter.
We were able to lower our total tariff forecast for the year by about $500 million from where we started the year. And I think it's that proactive partnership in terms of really making sure that we can remain competitive and help to drive more investment into the U.S., which we've done. We think that there's actually an opportunity for us to do better in 2026 and start to work our way back up to those 8 to 10% targeted margins that we set for ourselves before the tariffs were put in place.
For more on GM, we are joined by Bloomberg's Global Autos editor, Craig Trudell. Craig, not only were the results strong, the big and expensive trucks and SUVs did well, and they're continuing to raise prices. How big of a surprise is it that the pricey stuff is doing so well at GM?
Yeah, I mean, I guess it tracks with what we're seeing from the industry. We talked this morning about the idea that the average transaction price for a new vehicle in the U.S. just hit a record last month of more than $50,000. So we're seeing this industry sort of, continue to be able to take pricing. I think there are some questions about the sort of sustainability of that. Also, maybe some sense that may have been inflated a little bit by the fact that electric vehicles are still more expensive than the rest of the cars that you can get on the U.S. market. And we did see a big boost in EV sales last month and last quarter from all of the consumers that were looking to take advantage of tax credits before they went away. But all that is to say, GM is absolutely managing to sort of ride that tide and take advantage of these dynamics, and is doing so with brands like Cadillac and GMC that are really important to them, not only doing well on volume, but also on value.
It is also a sector, a company that is so exposed to policy, from the tax credits, which you were talking about, to tariffs. And in this earnings, the CEO, Mary Barra, thanked Donald Trump for extending a 2030 tariff discount on some imports. Craig, is this a GM that is now in the White House's favor?
I think Mary Barra has been very strategic about, taking a sort of line with this administration of trying to work with, as opposed to being critical in terms of, relative to even Ford, where you've heard Jim Farley talk about, a lot of costs and a lot of chaos. I think in his defense, we've seen both of those things in spades, and yet Mary Barra is working with the administration. I think while you heard Paul Jacobson, the CFO, talk about reducing their estimate for tariff exposure this year, they're still estimating up to $4.5 billion. So we are seeing manufacturers really take it on the chin with tariff costs. I think we also are likely seeing some incremental sales that the likes of GM are able to take advantage of, on the basis that they do have more U.S. production capacity than some of their competitors who are hit by these tariffs even harder.
Hey, Craig, thank you so much for that update on GM. Shares up more than 11% this morning. Bloomberg's Craig Trudell. Some other earnings to get through this morning. GE, they raised their full-year outlook. Shares up 2.4%. It's the second straight quarter that they've done that, citing strong air travel demand. Bloomberg Markets correspondent Nora Melinda joins us now. Nora, it echoes with what we heard from the other airlines that we've heard from. There is a demand to travel right now, and the likes of GE are benefiting.
Absolutely. You're really seeing a lot of green on the screen for GE Aerospace. They've had a terrific year. I mean, up more than 80% so far year to date. But what's really pushing them through this earnings season, of course, is what you called out, air travel demand, also rising demand for maintenance and new engines. This is really buoying this company forward. And you're seeing a lot of people pouring a lot of money into aerospace and defense. If you take a look at the S15 Aero Index, that is composed by defense and aerospace companies, and you do see aerospace companies as pretty much pushing that index higher so far this year.
How much of the success was due to retail travel demand versus defense? Because we also heard from some of the defense companies reporting earnings today.
We did hear from some of the defense companies. We heard from Lockheed Martin, which of course we know they're the largest defense operator here in the United States. We also heard from Northrop Grumman. Those are some earnings that we got through today. And this is also just seeing a lot of emphasis right now on defense here. We're of course getting the Pentagon, which is putting a lot of pressure on a lot of these companies to produce more missiles, especially as we think about the tensions that are rising between the U.S. and China. That's definitely been a lot of discussion between the Pentagon putting a lot of pressure on these companies, and you're seeing a lot of them ramping up their output right now.
Yeah, Northrop Grumman falling 2%, even though that they did raise their earnings forecast. Nora, thank you so much. Always a pleasure to see you. Nora Melinda of the Bloomberg Markets team here on TV. Now, elsewhere, shares of Coca-Cola are popping pre-market. Is that a soda pun? I'm not sure. The company's sales growth beat estimates despite higher prices. Shares up about 2 3/4%. Joining us now is Bloomberg managing editor for global business, Shelley Banjo. Shelley, be it travel, be it trucks, be it Coca-Cola, the consumer is buying things.
Today was a good day for earnings. I mean, I will cautious all of this with that we're very beginning of the business earnings, season, and there could be definitely a lot of negative surprises coming through. But today is the day that says, you know what? Everything seems to be humming around just fine.
On the Coca-Cola, the company executive said something along the lines of, everyone wants to be healthy right now, and that's why we're doing so well. Healthy and Coca-Cola usually aren't the two things that I'd put together necessarily.
Yeah, everyone wants to be healthier right now. So What does that mean? What does healthy even mean these days is a good question. But they are seeing good sales of, their water, their milk, their low sugar, zero sugar, all a sort of whole assortment of things that they are selling. And also they are raising prices as well.
And I guess the cane sugar in the Coca-Cola, the so-called Mexican Coke, came from President Trump himself, right? Last earnings, he made this big splashy announcement that they're switching to cane sugar.
Yeah, I mean, this had been something that had been in the works, and obviously you mentioned the Mexico Coke. It's something that they have been selling. But yes, they definitely bowed to Trump in that sense and said, yes, of course, President Trump, we will give you the Coke that you want.
Yeah, whether it be Mary Barra or Coca-Cola, their call out to the president. We are in this moment, though, and you've been writing about this, Shelley, that we don't have economic data right now. How much can we learn from that gap in the economic data via the strength we're seeing from at least the early days of earnings?
Yeah, so a lot of earnings can be backward looking, but the difference between this earnings, results are they're saying, okay, we're actually going to raise our outlooks because we're pretty positive and confident, for the next half of the year. And so what's been interesting to me is the last 10 months we've been hearing words like uncertainty and consumer weakness and, oh my gosh, what's going on? We don't know, tariff confusion, whatnot. In at least today's slew of earnings, there were words like confidence, optimism, upbeat. These are, sort of adjectives that, matter to investors when they're parsing every single little bit and don't really have the full picture of economic data.
Flying blind. At least we get CPI at the end of the week. We'll see whether that even tells us anything. Shelley, thank you so much for joining. That is Shelley Banjo. All right, in those slew of earnings, let's get a quick check on futures because it is the second busiest week of the earnings season, I believe. And we are a little changed. We are 0.02% lower on the S&P 500 after climbing higher yesterday, closing just 0.3% away from all-time highs. Yesterday, we were helped by the president saying that we might get closer to a China deal and optimism that maybe we are closer to the end of a shutdown. We are officially in the second longest shutdown in history, but it is small caps that are getting hit this morning, down 0.2%. Look at some of the other movers on our radar, because though that looks calm, gold has been increasingly erratic. It is down 3.4%. It is set for the biggest drop in 4 years. Just yesterday, it was up nearly 3%. It underscores the volatility that is not present in this bond and equity market. It is present in this gold and silver market, precious metals, some extreme volatility. And following on from that, precious metals and mining stocks are falling with that retreat from record highs due to maybe easing global trade tensions. Shares down some 6% for Newmont Mining and Barrick. Anglo Gold falls 8.3%. Meanwhile, Warner Brothers Discovery, they have started a review of strategic alternatives to maximize shareholder value in light of unsolicited interest it has received from multiple parties for both the entire company and Warner Brothers Discovery. Those shares up 8.3%. Meanwhile, Zyn maker Philip Morris, they also reported earnings. Their net revenue beat Wall Street expectations. They narrowed its adjusted EPS forecast for the full year, but were expectations high. Shares fall 1.6%. Meanwhile, Blackstone and TPG will buy medical device maker Hologic, in a deal with an enterprise value worth $18 billion. Those shares up 4%. Coming up, Zion's earnings eases concerns about regional bank credit. We're going to discuss with Herman Chan of Bloomberg Intelligence. That's coming up next on the show. You are watching Bloomberg TV. Let's look at some of our high interest stories, what's making headlines around the world. The U.S. Treasury has reached an economic stabilization agreement with Argentina's central bank. Treasury Secretary Scott Bessent posted this on X. He described the deal as a bridge to a better economic future aimed at helping Argentina restore stability and embrace market reforms. Bessent stressed the program is designed to support economic freedom, not serve as a bailout. OpenAI has hired over 100 former investment bankers for a secretive project called Mercury, training its AI to build financial models that could replace Wall Street's junior analysts. The ex-staffers from Goldman Sachs, JP Morgan, and Morgan Stanley are paid $150 an hour to teach the system how to handle IPOs, restructuring, and other deal work. The move also shows Sam Altman's push to make OpenAI's tech indispensable to industries like finance, even as the world's most valuable startup has yet to turn a profit. Junior bankers. Elsewhere in banking, Goldman Sachs CEO David Solomon said recent regional bank losses tied to alleged fraud look isolated, not systematic, nonetheless are still a wake-up call on underwriting. He pointed at failures at Tricolor Holdings and First Brands and losses at Zions and Western Alliance, urging lenders to revisit risk controls as the credit cycle turns for the first time in a very, very long time. Now, speaking of those banks, Zion's topped estimates despite a $50 million loss from an alleged fraud, helping reassure investors who feared the credit markets might expose deeper pain. Bloomberg Intelligence senior analyst Herman Chan says that the bank showed solid credit quality despite the charge-off, and he joins us now. So, Herman, is this nothing to see here? We can move on.
Yes, I think Zions did reassure the market that there was no other cracks within credit quality. And really, they mentioned that only 4 basis points of charge-offs outside of that $50 million that you mentioned earlier. So really good showing all around.
How much is it the all clear, though? We were looking at the pre-market share price. It was rallying first, and now it's given back some of that. It has yet to reach the level that it was before it announced that it had this exposure to an alleged fraud. Are there still concerns, at least for a wider investor base, that maybe there's a reason not to fully price things back to where they were?
Yeah, I think investors are still sort of trying to suss out the management team's comments from the call yesterday in terms of what the lessons learned and really what could they have done to prevent an issue that occurred. So really, we'd like to hear more from the management teams in terms of their due diligence, what their outside party is looking at in terms of findings, and I think there are additional questions that need to be resolved.
Well, we might get some answers, maybe, from Western Alliance earnings today. What are you looking out for from them?
That's right. So Western Alliance has 2 problematic issues: the First Brands indirect exposure, and also the same issue with the borrower with Zions. So I'm sure the management team will address those in their lending to non-bank financial institutions. But we do expect credit quality to be pretty solid all across the board for them as well.
Still what you continue to hear, and just talking about David Solomon saying this, that this is idiosyncratic, it's not a systematic issue, but then goes on to say this is what happens when the credit cycle turns. Is this a credit cycle that is turning right now? And if it is, what does it mean for some of these regional lenders?
I think we're seeing a slow turn. I'm not sure the dial is ratcheting higher. I would say that the earnings quality and credit quality for the regional banks that have reported thus far in 3Q earnings has been pretty solid across the board. We're seeing declining non-performers, criticized loans improving. So these are early warning signs that aren't really showing the cracks that the market was sort of worrying about last week.
Well, you feel the worry. The market feels primed for any wobble to sell off, although we are coming back somewhat, not for Zions this morning, though. Herman, thank you so much for joining. Always a pleasure to have you on. Herman Chan of Bloomberg Intelligence. A quick check on futures ahead of the opening bell, under 15 minutes away. Little change when it comes to the S&P and NASDAQ after gains yesterday on optimism of reaching a deal with China and a government shutdown ending. Earnings have been the topic du jour, not helping again to lift the overall benchmark. Russell 2000 futures, though, those are down 0.33% this morning, trading at 2,503. Coming up, the AI theme has supported 80% of the earnings and stock price returns since 2022. That's according to NorthStar's Nimrit Kang. She's going to be joining me next on her outlook for these markets as we sit here just under all-time highs. You're watching Bloomberg. Goldman Sachs says, quote, everything is weird when it comes to asset class movements. I believe that is the technical term, weird. Bobby Mavali says that historical correlations between bonds, equities, and gold are, quote, thrown out the window. He points to indexes, single stocks, and other assets like gold at record highs, subdued volatility, continued retail buying, and non-stop AI spending. Joining us on this everything is weird market is NorthStar Asset Management Chief Investment Officer Nimrit Kang. Nimrit, if we want to throw in another strange aspect of this market, it is gold. Charting new highs, up more than 2% yesterday, and this morning down more than 3% for its biggest drop in 4 years. This is supposed to be a staid, boring protection asset class. What does it mean to have so much volatility imbued into it?
We couldn't agree more. It is indeed a very weird market. You know, things that you historically could rely on, you can no longer rely on. I mean, whoever would have thought that the kind of volatility we're seeing in developed market currencies versus the emerging market currencies are doing relatively okay. And that kind of feeds into the whole theme around gold as well. You know, Dani, we've heard three big arguments as to why we're seeing the volatility in gold, or why gold has actually been the best performing asset class year to date. I mean, it's related to investors trying to hedge their dollar exposure. It's related to collateral for digital assets and cryptocurrencies. You know, there's a number of different reasons. And also because there's an increasing retail participation in the market, and gold might be seen as one of those meme areas for retails to participate in. We don't really know. But what we do know is if you look back 30, 40 years, gold has same kind of returns as equities, but twice the volatility. And that's what we're seeing come true today as well. And, you know, what we would expect going forward as well.
That volatility is real. And maybe that is a historical correlation that's holding up because it's an equity market that, yes, you've had some wobbles around trade, but for the most part, it has this melt-up quality to it that it just feels inching towards new highs or slightly above them. Nimrit, are you surprised that equity market volatility has been relatively calm, that some of the issues in the gold market, for example, this morning aren't seeping over to wider sentiment shifts?
Dani, actually, one of the data I saw just yesterday on Bloomberg said that equity market volatility is actually at its highest level outside of recession years. So we are seeing the volatility. I think when we think about volatility, we think up and down. The problem is we've only seen volatility going up, right? A lot of upward movement. But I think, you know, what is surprising is the kind of euphoria we're seeing in the market. In some ways, it makes sense because you're saying, okay, you've had this huge boom from AI contribution coming through, and now it's going to trickle down to the other sectors of the economy. I mean, you look at GDP estimates for Q3, 3.9%, inflation 3%. And this is an environment that we're looking to cut interest rates. So talk about adding fuel to the fire here. And we've got deregulation. All those things are bringing out what we would call animal spirits.
Can we talk about maybe some of the risks ahead, at least those that we know about? We have corporate earnings. The season is continuing to kick up into high gear. We're going to get a CPI report at the end of this month, an FOMC meeting, at the end of this week, an FOMC meeting on the 29th, and then we have the Trump-Xi summit at the end of the month. Nimrit, where is the event risk for this market?
The event risk, honestly, could be anything. It could be a tweet, right? Like we saw on October 9th, getting hostile with the China and the rare earths spat that we saw. So it could be anywhere. And you can see this how skittish the market is. Just that tweet and that back and forth on October 9th triggered a 3% sell-off in the S&P and about 4.5%, 5% in the AI names. So you see how skittish the market is, and it could be anywhere. And actually you see institutional investors looking to take profits at the first sign of there's any weakness. Another thing will be some of these earnings that we see come through a lot of the AI bellwether stocks in the next few weeks, and what that means, and if they can continue to give confidence on the momentum and investment into AI.
Only about a minute here, Nimrit, and we'll get more into earnings after the next break. But considering we're back above where we were those levels after the Trump tweet, is this a market that you want to buy those dips, especially those policy-induced ones?
Dani, this looks like a very dangerous environment to us, because you are seeing this phenomena where buy the dip is the your default way to play this market. But we're very cautious. We're very we think it's a very dangerous environment because you are continue to seeing that concentration. I mean, just on the earnings too, right? You see this big bifurcation between the AI names and the rest of the companies. So until we can see that momentum, we wouldn't be buying the dip here.
Yeah, and there you see, since the tweet, we are now unchanged on this equity market. Nimrit, much more to discuss. Stay with us. Nimrit Kang there, and a quick check on futures as we are little changed, just moments away from your opening bell. You're watching Bloomberg TV. You are just moments away from the start of your cash equity trade. You are watching Bloomberg Open Interest. I'm Dani Berger. It's a market that is flat to down for the futures trade. Actually flat to up, I guess, for the S&P 500. But not a lot of things to move on, except some pretty strong earnings, I should say. But that's not moving the dial. After we finished yesterday, just 0.3% away from all-time highs. The Russell 2000 Futures Index is weaker this morning, down about 1/3%. Even so, we are looking at extreme volatility in gold. How is that shaping things up? Over here at the New York Stock Exchange, we got some beautiful outfits ringing the bell. RHP, they are a REIT and they own the Grand Ole Opry down in Nashville, hence this southern-looking majesty that we are seeing out of them. Dolly Parton, the likes of those have played out there. Truly a historic venue. Looks like they're celebrating 100 years of it. In a very different tone. Cybersecurity, Okta, they're ringing the opening bell this morning. They were on this very program yesterday. Sadly, I was not here, but the chairman talking about AI threats to the world. So if you want to be able to not sleep tonight, I would recommend going back and watching our interview with them. Even so, markets are open, little change, and there are some stocks that we are keeping an eye on at the open this morning. General Electric, those shares up 2%, a full year outlook for a second consecutive quarter that was raised. They see strong air travel demand. Larry Culp's bets on this company really paying off. General Motors, those shares up 8.8%. They raised their full year outlook. They had a better than expected pickup truck sales and tariff relief. Mary Barra in the earnings writing a letter to President Trump saying thank you for allowing us the relief of tariffs until 2030. Finally, Warner Brothers Discovery, those shares are up 8%, climbing. They announced a strategic review of their assets, and it follows offers from multiple parties, including that one flowing around from Skydance. So again, those shares are outperforming this morning. Still with us, Nimrit Kang, Chief Investment Officer at NorthStar Asset Management. And Nimrit, before the break, you were just talking about the fragility of this market and how it's a dangerous time. Even so, we had earnings from Coca-Cola, from GE, from GM. GM, for its part, everyone's buying those big, expensive trucks in SUVs? Is the consumer still acting as an underpinning, as a floor for this equity market?
The consumer has been extremely resilient. And the earnings today from General Motors are very heartening because these are the kinds of companies that have been really crushed with the tariff uncertainty, the trade wars, the weakening consumers. So those are very good data points. At the same time, Dani, it is too early. I mean, it's too early in the earnings season. We really got to hear more from the retailers. One of the themes that we've heard over and over again is the down trading, how the lower end consumer, the younger consumer is barely making it. I mean, just even look at the auto delinquencies reaching almost for the subprime, reaching almost 7%. Student loan delinquencies, almost 11-12%. So we would say it's a tale of two types of consumers. The wealthier consumers that have the jobs not impacted by the AI, phenomena, they seem to be spending, holding up the economy. They're also benefiting from the wealth impact from the stock market. And then there's the rest of the consumers that are just barely struggling to get by.
It's been the case for some time now, and it exacerbated by the outcome of COVID and continuing, feels like, to be exacerbated to the K-shaped economy that's been talked about and written about ad nauseum. Nimrit, is there a point where obviously it is horrible to have this divergence, especially for those that can't afford or are struggling every day, but at what point does that impact headline economic concerns? At what point does it lead to wider trends where maybe some of the middle and upper income folks as well start to feel the pain and it shows up in markets?
Yeah, so two things have to happen, right? Either the lower income consumer has to start seeing the trickle down effect from all the spending, from the wealth effect, from the AI spending investments that we're seeing, or we see some deceleration actually come through for the higher end consumer. It's actually the same case we're seeing even for the companies. Large cap continues to do well, whereas small cap continues to struggle. Large banks are doing really well, trading, investment banking activity. Smaller regional banks, not so great, dependent on loan growth, and loan growth still remains very tepid, 1% to 2%. So this bifurcation is at so many different levels, and one of those two things have to happen. They haven't happened. We've been talking about it, so maybe they don't have to happen, and it can continue to go on into perpetuity. But if you look at historical data, it's the numbers game. At what point do we start to see the same cohort of consumers, the same cohort of companies just keeping the rest of the economy afloat?
Putting all this together, Nimrit, you are quite cautious. I think that's fair to say. At a time when you see, at least from the sell side, they've been raising their year-end estimates day after day. How do you express that cautiousness? Because it could be quite painful to take a step back or not to fully participate in some of the FOMO AI chasing that's happening in this market.
It is absolutely painful. You're absolutely right. One of the things that we've been talking a lot about is diversification. Diversification outside of just the same theme of stocks, same types of companies, large companies, diversification. And diversification has not really worked. That's actually the fact. But I think what you have to do is, yes, in an uptrending market, in a strong momentum market, it doesn't work. It's painful. But, there is the other side of that. That's the downside. We've lived through it over and over again in the history. Just look back at 2022, even before that. And you've had these periods where diversification does work. And I think ultimately it comes down to what is the intent and the objective of the portfolio? Is it to get rich quick and participate fully in the market, or to preserve and compound wealth? And in that case, I think diversification is a strategy we would still anchor around.
Is it concerning that it feels like the get rich quick thing is so dominant, especially in retail? Maybe it is born from COVID and all the crypto that's been doing well, but you look at these betting sites and every day there's some bet that you can make. How many times they say Chipotle or they say burrito in the Chipotle earnings call, for example. Are you concerned that that behavior is really picking up, especially among the younger cohort of investors?
It is concerning. A lot of the younger investor and younger consumer demographics have been priced out of the whole housing market, and yet they are increasingly participating in the stock market and also participating it at a level that we haven't seen in really decades at this point. So yes, it's concerning. I mean, the same thing when OpenAI was announcing its framework for $1 trillion of deals. The stock market kept going up. All these stocks continue to add billions, hundreds of billions of market cap in response to these framework deals that have yet to materialize into revenues, cash flows, earnings. So absolutely, it is concerning, but that is the name of the game today. The question is, how long can it persist? I think our concern is the lot of retail investor that's participating and more active in this market is not well equipped to see the other side of that. And when you marry that with the fact that we have less and less regulation, it is concerning in the long term.
Hey, Nimrit, we're going to have to leave it there on a very sobering view of this market. Really wonderful to have you on. Please come join us again soon. NorthStar's Nimrit Kang. A quick check on this equity market about 8 minutes into your trading day. You are looking at basically an even amount of movers to the upside as to the downside. We are just ever so slightly higher on this equity market. What is leading us there? Amazon, I guess there's some happiness that AWS is up and running again. That's great. AWS and Amazon didn't crash the world's internet. Apple, that had traded, closed at a record high yesterday, trading at another record this morning, up 0.5%. Elsewhere, you see some of the winners of this earnings season, this earnings day. RTX had earnings, they did well. General Electric, Coca-Cola, those did well too. To the downside, ouch, Alphabet down 1.3%. Philip Morris, they also had earnings. Expectations are high, I suppose, with how much everyone is having those gross little Zyn packets. Sorry if you are among those who have them. Those are down 6%. NVIDIA, Broadcom, some of the big tech names, Oracle also down this morning. But again, we are higher by 0.07%. So let's get a look at the sectors and how that is shaking up, what's winning and what's losing. The big loser this morning does seem to be materials to the downside. Utilities follows a close second behind, along with communication. So some of the AI names in that. To the upside, industrials, I would hesitate or take a guess that a lot of that is because some of the defense stocks like Northrop Grumman and the like had good earnings. Consumer discretionary, again, that's Coca-Cola, also with some solid earnings alongside GM. So that's what we're looking out there. But coming up on the show, some more corporate news for you. CoreWeave standing firm on its offer for Core Scientific. Despite opposition, we have the latest on the potential deal. And all of that happening at the Bloomberg Tech Summit in London, which is currently underway. The CEO of Helsing is speaking with Bloomberg Tech anchor Tom McKenzie. Helsing is Europe's most valuable defense startup. He's talking currently about all of the money going into that sector. And you can watch that conversation on your terminal by typing Live Go.
I'm not going to make it. Talking of your acquisition strategy, if you can just outline that for us, because you recently made an acquisition in Australia for underwater drones. So you've got the air drones.
All right, over 10 minutes into your trading day, let's get some top calls, some of the analyst action that we are watching this morning. First up, Wells Fargo, they cut Cleveland Cliffs to underweight, citing excessive exuberance after it rallied 21% yesterday. The analysts say that rally looks unwarranted, so shares plunge 13%, still up though over the past 2 days. Next up, Goldman Sachs, that gets a downgrade at JP Morgan. Analysts there say the stock is fairly valued and they prefer European rivals like Barclays or Deutsche Bank. They also add that share buybacks are not very attractive at Goldman's valuations, but those shares, little change this morning. Finally, BNP Paribas Exxon cutting its rating on Verizon and trimming its price target. The analysts say that the new CEO's arrival has created uncertainty. They also expect higher spending tied to fiber expansion and customer retention, with costs that will likely exceed expectations. Those shares down 0.7%. Now, in other corporate news this morning, CoreWeave will not be increasing its $9 billion offer for Core Scientific, despite opposition from major shareholders. CoreWeave CEO broke the news at the Bloomberg Tech Summit in London earlier this morning.
If there's someone else that would like to step in, they can step in. But we're excited. We think it makes sense. We continue to think it makes sense. And it will go to a vote. But you won't see us bump our price or increase our price.
Let's get more on the takeover bid. We're joined by Bloomberg Tech co-host Ed Ludlow. Ed, it feels like a moment where everyone is willing to pay huge sums for data centers, their firstborn child, one of their limbs, whatever it takes. Was it surprising to hear the CEO there saying that he wouldn't up his offer?
No. He said exactly the same thing on October 7th on this network. So, from CoreWeave's perspective, their position hasn't changed. They're not going to budge. Team can bring up the Core Scientific shares. That's nice timing. We're trading at $19 a share. The offer from July was $20.40 a share. The bit that's new or news is that Monday, ISS, the proxy advisor service, recommended that shareholders vote against the deal. And you'll note, Dani, that a number of Core Scientific existing shareholders already voiced their concerns about it. It values the company at $9 billion. The pressure point is that the vote's on October 30th. So we're closer to that now. And what was interesting was to hear Mr. Intrator say maybe someone else will come in for it. Because you're right, what they're getting with Core Scientific is a company that's good at building data center capacity very quickly, and that they already work with in that context.
Is there another natural bidder for this company? Who could be coming in for Core Scientific, if not CoreWeave?
Excellent question. We don't know. We don't have the reporting on it. What I would say is that a lot of the Europe or Britain-based, UK-based, similar names, neo-cloud and sort of fast-moving infrastructure companies have got a lot of backing at the moment, and a lot of capital. It's analogous. I'm not saying this is an option, but Nscale, right, is a similar kind of company. So it was interesting to hear Mr. Intrator invite that idea. Maybe it's just his confidence that somebody won't.
Meanwhile, Warner Brothers Discovery, every day it's, are they going to break up? Is someone going to buy them? Is someone else going to buy them? Ed, the latest, it appears that they are considering various options. What are the options for this company as it stands?
So they're basically threefold. Continue with the existing plan, which is to separate Warner Brothers Discovery into two businesses, one focused on legacy cable TV and the other a streaming and studios business. That's the existing plan that was in place for mid-2026. The board is saying that because of these unsolicited, quote, bids, they could also look at selling off one part of it or the value of their portfolio in aggregate as a whole, although they don't name the bidders. I would say, since you've been on air or we came back from break, Dani, there are other media reports that it is Comcast and Netflix that are looking at the Warner Brothers Discovery portfolio. And you'll remember that Bloomberg reported about Paramount Skydance considering or making an unsolicited bid as well. So this is the board formally reacting, and the stock up 9%.
Ed, you were at Screen Time. It's a lot of changes coming to this industry. What does it say about this moment that there are so many bidders for Warner Brothers Discovery, that what initially started as a story of slimming down, to your point of the two splitting off, is now turning into maybe the media giants getting even more giant? Yeah,
it's the same idea that content is king. That at least through the wording of the executives and the board in this Warner Brothers Discovery statement, they're recognizing that there is a value that they've been able to find with the portfolio on the studio and streaming side in particular. When Netflix rolls around this evening with earnings, it's the age-old story, which is how have the shows that they've put out done, and what is the pipeline for new shows? Because it will drive all of the historic and common financial metrics that Wall Street looks at: advertising, revenue growth, margin expansion, etc. Now that the broader environment for streaming is a bit better, and they've worked out the balance between ad-supported pricing and non-ad pricing, content is king. I think that was the message. So, Ed, fair to say that we're expecting an upbeat report from Netflix today, then, given what you're saying? So Netflix has 300 million subscribers, right? And they don't give us this sort of contemporaneous subscriber data anymore. Executives at Netflix have been banging the table for a long time saying, Wall Street, please just judge us by our financial performance. But the ad business in particular, and ad revenues and how that impacts profitability, is a big focus for the street tonight. And that's where they will benefit. Also, I love this, the editors roll their eyes at me, Dani, but I think you might vibe with me on it. Currency impact. They might get favorable FX, and when the release hits, sometimes people are like, oh, that's boring. Really important. Netflix has a big footprint outside of America. think about how they're doing business in those jurisdictions. So yeah, I think that's cool.
I can't believe anyone here at Bloomberg would be bored by FX impact. If you're going to be excited about it, this is obviously the place to do
Probably
that.
just me then, just rolling their eyes at me, whatever the subject matter.
Ed, we would never roll our eyes at you. Thank you so much for joining us. Bloomberg Tech co-host Ed Ludlow. And of course, 11 a.m. Eastern, tune in where Ed Ludlow has Bloomberg Tech, and we'll go through what's to expect for some of these earnings. Coming up, speaking of earnings, both GE and 3M boost their outlooks for the second straight quarter. We're going to have more on corporate results in this, the second busiest week for American earnings. That's coming up next. You're watching Bloomberg Open Interest. You're watching Bloomberg Open Interest, 20 minutes into your trading day, and equity indexes unable to hang on to the near record high levels that they were yesterday. The Nasdaq down by 0.2%. Some of the giants like Nvidia falling today. The Russell 2000, that performs even worse, nearing a 1% loss this morning. Again, after the indices were just 0.3% away from all-time highs yesterday. That happening despite the fact that 10-year yields are moving lower. In the words of Goldman Sachs, everything is weird and correlations do not make sense. Maybe the poster child of the weirdsies this morning is gold, down 4%, on track for its biggest daily loss in 4 years after touching all-time highs. Apple also at all-time highs, up 1.1%. Coca-Cola, GM, really strong earnings for the two of them. The consumer is alive and well. Same story goes for General Electric and 3M. Both GE and 3M boosted their outlooks for a second straight quarter. Joining us now is Brooke Sutherland, Bloomberg's Boston Bureau Chief and the writer of the Industrial Strength newsletter. Brooke did also, I should say, just get off the phone with GE CEO Larry Culp. Brooke, the earnings themselves, the consumer demand is strong. How much of this was about defense versus just air travel and the fact that we still want to go everywhere in the world?
Yeah, I mean, I think actually what's interesting that you've seen from GE and other aftermarket aerospace suppliers is that their growth has really diverged from what we've seen in terms of air travel. And so, departures globally are actually trending below, what was sort of expected at the beginning of the year, as a lot of this uncertainty sort of takes its toll. But you've just had such a buildup in the aerospace market because of those supply chain challenges that companies are still, working as hard as they can to satisfy that demand. And you're seeing, that really robust growth continue to play out here. And I think, you're going to continue to see this divide as we get deeper into earnings season between the industrial companies that cater to more of these growth markets, aerospace in particular, and then certainly anything that supplies the AI data center boom versus, your typical industrials that do more kind of quicker turnaround products. I mean, that's an area that's been under a lot of pressure, and there's not really a sign of improvement there. And I think you saw 3M talking to that point today, where they talked about, the macro environment into 2026 will likely be the same as 2025, which has been pretty sluggish for the general industrial market.
How much of that sluggishness also has something to do with the quickly changing business environment, with the confusion and the back and forth on tariffs, what level we do or don't have with China and other countries?
I think that has a lot to do with it. Coming into this year, there was a lot of enthusiasm that we might start to see a rebound in the general industrial market. Remember, this is an area of the economy that's been really slow for a couple years now, and analysts were really looking for a pickup, and that has not materialized. And what you hear from CEOs is tariffs are one thing, and whatever the cost is, they will figure it out. They will adjust their business as needed, but they need to know what the rules of the road are, and they still don't know. There's a lot of changing policies. There's new tariffs, announced constantly, new investigations into imports of certain products, and that makes it really difficult for companies to plan. And if you think about investments, you need to know what these things cost. If you're going to build a new factory, you need to know what it's going to cost to do so, and what that trade environment looks like down the road. And so that's continuing to handicap decision-making among manufacturers.
Well, Brooke, we're really looking forward to reading about your conversation with Larry Culp. Keep an eye out for that. That is Bloomberg's Brooke Sutherland joining us. She's on the road today in Paris. I can promise you that is not the skyline of Boston in the background. Coming up in the next hour, some fantastic conversations you do not want to miss. Harris Oakmark's David Herro tells us where to find value in this market, plus the CEO of EQT on AI energy demand and potential acquisitions for the company as a whole. This is Bloomberg Open Interest on a day when equities fall just under all-time highs. We're 30 minutes into your trading day with equity indexes losing steam, just barely, down 0.1% for the S&P, down a third for the NASDAQ 100. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is off today on a well-deserved break. Coming up on the show, earnings season kicks into high gear, corporate America providing an upbeat picture in the absence of economic data. Meanwhile, investors weigh signs of easing trade tensions as President Trump predicts a fair deal with China. And OpenAI has hired former bankers to help train its AI as it looks to eliminate the grunt work done by juniors and maybe their jobs altogether. But for this equity index, we are just inches away from all-time highs, despite some of the red today. It's been driven by momentum chasing as Apple and the Philadelphia Semiconductor hit their own fresh records yesterday. The momentum factor itself has outperformed this year, while value has started to fall behind. Joining us this morning, I'm pleased to say, is the value investor. It is David Herro, who is CIO of International Equities and Portfolio Manager at Harris Oakmark. David, wonderful to speak with you. And just given everything we are seeing in the market, it has this feeling of momentum chasing, wanting to go after the next flashy, shiny AI thing. Is it hard to be a value investor?
It's actually easier to be a value investor, but because of this momentum chasing, as you would say, and because of this euphoric feeling in a very, very narrow group of investments, it opens the opportunity set for value investors. Ultimately, to us, as value investors, we believe a company's price should be determined by the cash flow which that business generates. Now, in markets like this, people don't care about cash flow. They don't care about earnings growth. They just care about, the word you use, momentum and the flavor of the day, the shiny new toy, as you said. And even though it's painful to miss this, when we do see a return to fundamentals, it will become quite rewarding. Because remember, as investors, we're buying financial assets, and those financial assets ultimately have to be tied to a cash flow stream.
To your point, David, not only are they not rewarding cash flow, it's the tech giants that have pushed cash flow, free cash flow to the side, and are just getting rewarded for CapEx. The more you spend, it seems the more happy investors are. To you, how out of whack does that feel with fundamentals, and how painful then does it look when we do move back to fundamentals?
You know, this is typical of a behavior of kind of a mania. What happens, here's an example, the optic fiber craze of, the early 2000s. Everyone was building capacity. Everyone wanted the cable companies, the suppliers, everything involved with optic fiber. 3 or 4 or 5 years later, you have massive oversupply. Why? Because everyone does the same thing at the same time. In Econ 100, we'd call it a massive shift to the supply curve to the right. Now, it's fun while it's happening, but when it's all said and done, when everything's all built and you're operating at 30 or 40% of capacity, it's not so fun. And all of a sudden, earnings get stretched, and you'll see, even before this happens, the rotation of money out of some of these things. But right now, it's all fun and games. They're all building up. The data center bubble is probably going to continue to get built. People are going to keep investing. People are going to want to have any involvement in any of these things that are tied to AI, and they'll buy first and they'll worry about oversupply later. But the oversupply will come. That's what markets tell us, because industry participants don't know how to put the brake on. If everyone is doing it, why can't we? If it feels good, do it, and that's what happens. As an investor, we have to look ahead. We have to be able to assess whether all this capital being spent is going to earn a return. So if you think of $1 billion, in your mind you should be thinking, where's the 100 million, 150 million that I'm going to get out of that billion that was spent? And I think right now people are ignoring that, and they're just looking at the go momentum and where the hot money is going. So again, not good for value investors at first, but eventually everything comes back to the fundamentals.
If I can play devil's advocate, because for those who are really bullish on this sector, David, what they would say is this is a transformational technology, and the potential for it, not just in the tech advancements, but the potential revenue coming in with the widespread adoption of AI is something that's even hard for us to wrap our tiny little human brains around. So maybe therefore the fundamentals, what you're pricing into the future, is also hard to understand. And in the words of Mark Zuckerberg, it's better to overinvest than underinvest. Does that argument have any merit whatsoever?
Well, clearly it's very transformational, and we've gone through these. Look at the last couple hundred years. The railroads, transformational. Electricity, transformational. The automobile, transformational. The internet, transformational. All these things created step changes. Joseph Schumpeter called it creative destructionism. There's no doubt about it that what we're seeing today with artificial intelligence and advancements in technology will be transformational. However, that is the theme. Eventually, as an investor, you have to be able to make money out of it. How many railroads went bankrupt? How many electric utilities went bankrupt? Because what happened was you had oversupply, a very, very heavy foot on the investment pedal in narrow areas. And then when things begin to slow down, it's as if the tide goes down and all of a sudden the emperor has no clothes. Absolutely transformational. And there will be winners, and there are companies that will be huge beneficiaries of this. And even industrial businesses or business services, all kinds of companies will have lower cost base as a result. And today they're not even being considered in this whole AI euphoria.
Let's talk about where you can find the value. David, you are, of course, a prolific investor in Europe, and that's a bet that has paid off this year. Europe is still outperforming the U.S., but that gap has been closing. Can the outperformance continue through the rest of the year?
Well, to be honest, a lot of this gap is due to a little bit of a rebound in the euro and the European currencies. The dollar's come off its all-time high. The dollar index, the DXY, I think at 108, 109, and now it sits at 98, 99. Don't forget, in 2014, this was in the mid-70s. So the dollar has really, since 2013, 2014, it has climbed very aggressively, and that has hurt the returns for U.S. investors into foreign equities. And this is why, for such a long period of time, people said, well, why should I go overseas? Look, the S&P 500 has outperformed. So you've had this dollar headwind. You've also had a massive increase in the valuation differential between U.S. and foreign, specifically European equities. Traditionally, you see a 16% discount. Europe to the U.S. today, I believe it's around a 35% discount. So this has manifested itself in a much higher PE of U.S. stocks, 25, 26 times, and actually European stocks are now only at 13 or 14 times. So you see this huge valuation differential that has also been a headwind for the performance. This year we're seeing a slight turn, just a slight turn. So I think we're in about the second or third inning of maybe a bit of a rebalancing. Investors are still very weary. They don't want to go outside the U.S., U.S. exceptionalism. But I think with the currency turning and the earnings growth coming through in Europe that makes those valuation differentials even seem larger, it's still very worthwhile to get non-U.S. exposure. One needs to be diversified, especially when we see turns like this beginning to happen.
There's always the individual company risk that something unforeseen happens. BNP, for example, David, has been a really good holding in your portfolio. It's been outperforming. It started to flatline, and then you had yesterday where shares plummeted off the back of this ruling over potential liable for its role in enabling genocide in Sudan. Does that make you rethink your holdings of BNP?
Every stock you own at any given day, we had Reckitt and Binkheiser with, the lawsuits in the U.S. We had Bayer and glyphosate lawsuits. You could wake up any morning, and this actually was kind of a surprise, because this seems to be very frivolous, and it seems to be something that's going to be, rapidly overturned. But, absolutely, it's something you have to look at. And as a bottom-up stock picker, you are exposed to these types of events. And even, when the no confidence vote happens in France, and in one day the market's down 6 or 7%. We went through a couple of those in the last year or so. But ultimately, what you have to do is analyze and see what these events, what these shocks have actually done to the underlying intrinsic value or the ability of the business to generate cash flow streams for its owners. And if the answer is it's had very little impact through time, then these types of things become a buying opportunity. Because even though the price moved quite dramatically, the fundamental change in value in many of these instances hasn't at all. It's maybe a little too early to examine BNP, but it sure looks like that the market way overdid that movement down yesterday in price.
So, David, you're not yet buying the dip in BNP, or you are?
Oh, we can never talk about our trading, but nice try.
Worthy a try. David, how about this one? Just taking a step back and looking at financials in general, there's this concern that maybe we're starting to witness the turn of the credit cycle, that you have regional banks like Zions, for example, Western Alliance, that are exposed to late cycle dynamics where underwriting has gotten lazy, or certain things, or maybe fraud has been overlooked. Should this be a real concern for equity investors? Are there the cockroaches still out there that you need to be wary of?
I am a bit more concerned about what's happening in the private credit world because it's less regulated, there's less eyes on it. I think the banks, of course, have increased their underwriting standards since the financial crisis. Look at the capital on balance sheets for banks. I mean, we've gone from 3 or 4% to 10, 11, 12, 13%. Even if there are a few more losses, there is a much, much stronger capital buffer than existed pre-global financial crisis. In fact, one might even say in the case of commercial banks, many of them are still overcapitalized. So I'm less worried about that. But when you had so much money going into private credit, it becomes the theme of the day. Then the recipients of this money think, oh, we got to put it out. And maybe they become less picky on who they put it out or give it out to. So I'm less worried about the banks, and I guess I'd be a bit more worried about what's happening in the whole private credit environment. Having said all of that, the U.S. GDP is growing at 3%, or has been. We're still at basically full employment. The consumer is generally healthy because we are at full employment. Of course, there are strands within the demographics that are less healthier, but we're not in a distressed consumer state. And don't forget the consumer is 66, 67% of GDP. So I think in order to get softness in the credit cycle, you need a much weaker consumer. And we just don't see that. And we don't really even see an over-levered consumer. So I think there will be spots, there will be more roaches. You know, as they say, when you see one, there's many. But I'm not so worried about the commercial banking system, given the state of the economy, the state of the consumer, and their state of capital.
Yeah, these earnings have been remarkable, whether it be GM or Coca-Cola. Today, the consumer is buying everything from trucks to sodas. David, I know that there are some private credit players who would definitely defend themselves and say it is not us, it is the banks. But if it is private credit and you don't have the issues of deposits going wrong, there's not that risk within it, is there a systematic risk? Could there be a wider spread impact if there are real concerns with private credit?
I'm sure it will filter a little bit into the banking system. You will see a little bit of this, but you're exactly right. When you have a crisis is when the depositors worry about the financial institution and they line up to take money out of the bank. Because remember, we have a fractional reserve banking system. As George Bailey would say, your money is in your neighbor's house. And so it's certainly less of a problem with private credit. And if we have a good visibility in their underwriting standards, and if they could demonstrate that as a result of the flood of money, they haven't loosened up their underwriting standards and they're well covered, then it won't be a major problem. But I think that's the if, and the question is, do we have the visibility into their standards, into their loans, like we do with commercial banks that are often audited by state and federal agencies?
David, this has been a masterclass. Thank you so much for joining us. Please come back again soon. That is David Herro of Harris Oakmark. Let's now get a quick check on markets this morning because you are about 45 minutes into your trading day and you're looking at losses, not steep losses, but losses nonetheless, down 0.06%. The NASDAQ down 0.2%. Maybe someone was listening to David Herro when he said that this is a market that looks stretched, that there is momentum chasing, and they are positioned for that unwind to happen in value stocks to be the ones that outperform at some point. But then to the point of weird correlations, despite the fact that you have equities underperforming, you do have yields coming in. They are down 3 basis points rather for your 10-year yield. That trades at 395.13. A quick look at some of the single stocks moving this hour. GM raised its full-year outlook, better than expected pickup truck sales and tariff relief. Meanwhile, you're looking at BNP, though, that is falling some 9.9%. There you go. GM up 13.7%. General Electric, they boosted their full-year outlook for a second consecutive quarter. They cited strong air travel demand. Shares there up more than 1.5%. Meanwhile, Warner Brothers Discovery, they climb after announcing a strategic review of its assets. There are multiple offers coming from multiple parties for this company. Shares up 9%. Coming up, President Trump lays out a hardline wish list ahead of next week's face-to-face meeting with Xi Jinping as a fragile trade truce ticks down. Details next. You're watching Bloomberg Open Interest. Get you some high-interest stories this morning. A look at what's making headlines around the world. Former French President Nicolas Sarkozy entered a prison in Paris today, the first day of a 5-year sentence. It marks the first time a former leader of modern France has spent time behind bars. Sarkozy was found guilty of criminal conspiracy for his role in a scheme to finance his 2007 presidential campaign with funds from Libya in exchange for diplomatic favors. He's expected to spend limited time behind bars. His lawyers have already requested early release. Big Bitcoin holders are moving their wealth from blockchain onto Wall Street. A new wave of ETFs run by firms like Blackroock now let investors swap their tokens for fund shares, a tax-neutral in-kind trade approved this summer. The shift turns volatile crypto into a regulated asset that can be borrowed against or folded into estate plans. BlackRock says it's processed over $3 billion of conversions as once anti-establishment Bitcoiners embrace the convenience of traditional finance. And President Trump named rare earths, fentanyl, soybeans, and Taiwan as key flashpoints with China ahead of his meeting with Xi Jinping next week. Yesterday, Trump said that he believes a trade deal with Beijing is possible.
I expect we'll probably work out a very fair deal with President Xi of China. So most of you will be with us. It's going to be very exciting. And I think we're going to work out something that's good for both countries.
Let's get more insight on that meeting and the latest trade negotiations. We're joined by Washington correspondent Tyler Kendall. Tyler, the president seems optimistic that they'll reach some sort of agreement at the end of this month.
Right, Dani, exactly. You heard him there telling reporters yesterday at the White House that he expects a fair trade deal with China, in his words. But he also reiterated that that threat of additional tariffs against Beijing on November 1st remains on the table. At the same time, it's worth mentioning the timetable here because November is also the enforcement period for Beijing when it comes to their newly unveiled export curbs on critical and rare earth minerals. And it is that timetable that is giving way to this expectation that there is going to be room to negotiate here. But it's clear that the White House is trying to bolster its position ahead of these critical talks between President Trump and Xi Jinping next week. Just look at yesterday, for example, the U.S. signing this critical minerals pact with Australia, widely seen as a way to bolster its standing against China's grip on the market. And while President Trump seems to be softening his rhetoric perhaps against China, I did want to mention that we got one stark warning from the USTR, Jamieson Greer, yesterday, issuing this threat against China not to retaliate against any foreign companies that are looking to help the U.S. when it comes to their standing in some of these critical sectors, even beyond rare earths. Dani, he issued this warning of unspecified action against Beijing after we saw them last week move to sanction 5 U.S. entities of a South Korean shipping giant, really expanding a maritime dispute between the U.S. and China. But it just goes to show that this is all going to be a balancing act as we lead up to next week in South Korea.
It's a lot of work just to stand still, Tyler. And speaking of standing still, we are still in a government shutdown, day 21, which we now enter the second longest period of any shutdown. Kevin Hassett was speaking about it likely ending soon. Does it seem like negotiations are starting to get somewhere?
At this point, we haven't gotten any indications that these negotiations are moving along. Our understanding is there's some informal bipartisan talks happening on the Hill when it comes to potential structural changes to the Affordable Care Act premium tax credits that are really at the center of this debate. Potentially, we could see some sort of income cap put into place as one example of a compromise in exchange for a longer extension of the program. But ultimately, Republicans are holding the line that they can't talk about that until the government reopens first. That is the red line here. Ultimately, we do know that Senate Majority Leader John Thune has promised Democrats that they could have an up and down vote, as it's called, on a one-year extension of these tax credits. But again, the government needs to reopen before that happens, he says.
Tyler, thank you so much for your excellent work this morning. Bloomberg's Tyler Kendall. Still ahead on the show, we're going to bring you my exclusive interview with EQT CEO Per Franzen, the world's second biggest private equity fund. That's coming up next on Bloomberg TV. Just under an hour into your trading day, a check on markets where the S&P is fighting for gains. Little change this morning with some of the worst of the losses this morning recouping themselves. What is not doing better is gold. Look at the bottom of that screen. 4.6% decline, going up to 4.7. We are on track for gold's worst day in 4 years. The dip buyers are nowhere to be found after gold hit a new record yesterday. Is some of that hesitancy, that sentiment there, is that what's seeping into equity markets? What's causing this? Is it better trade deals that potentially will get something with China at the end of this month or an end to the government shutdown? Either way, painful for gold this morning at $4,153. Coming up, EQT plans to invest $250 billion in the U.S. We'll bring you that exclusive interview with the CEO coming up next. The CEO of Swedish private equity group EQT says the firm is planning to make significant investments in the U.S. EQT is the world's second largest PE group based on capital raised. I spoke with the CEO, Per Franzen, earlier on the sidelines of EQT's Investor Day here in New York City.
We see really attractive growth opportunities across the platform. Geographically, the U.S. is definitely a large opportunity, big opportunity for us. We're going to make significant investments into our organization here in the U.S. And over the next 5 years, we actually expect to invest more than $250 billion here in the U.S., which would be an increase compared to how much we've invested in this part of the world historically.
It is a more crowded market, though, here in the U.S. So where do you find those opportunities?
It's really across the platform, right? I mean, if you look at our business today, 50% is in private capital, a third in infrastructure, and the rest in the real estate strategies. So the opportunities that we see here in the U.S. and the opportunity to grow is really across the platform and across those business lines.
Huge deals are being inked when it comes to infrastructure. There's a rumored a $30 billion one with Meta and some private capital players. Would you look at deals of that size, considering the price tags that are on these things?
Yeah. I mean, we have one of the largest, or we're currently investing in one of the largest infrastructure funds with Infra 6. And AI, I think, is a generational opportunity for us across the platform, certainly in the infrastructure strategies. And it's true, whenever there's a technology shift like that, there's a risk of excess valuations or capacity overbuild. We were well positioned, we believe, to invest into this theme and in this trend, and also opportunities of the scale of this size, given the fund sizes that we have, would be an opportunity for us.
There's risks of over-investing. You're confident in your strategy, but when you take a step back and look at what everybody else is doing, do you see pockets of that concern you?
As I said, there's definitely a risk of that, right, when it comes to AI, and there will be winners and losers. we're focused on just investing in the smartest way, in the best possible way, in this theme, in this opportunity across the platform, in our early stage strategies, in native AI opportunities, and also in our infrastructure platform, in data centers, energy providers, fiber infrastructure.
Of course, your roots are in Europe, but a lot of your American rivals have been moving into Europe too. Apollo recently said that the continent has fertile ground. Blackstone had their big splashy $500 billion they plan to invest over the next decade. How has that competitive landscape changed what you do in Europe?
So it's true, we're definitely seeing an interest from investors, public investors, private investors, to allocate more capital outside of US dollar-based assets right now. Investors want to rebalance their portfolios, and Europe will benefit from that trend. So I really see it more as an opportunity for Europe. We also see policymakers, regulators wanting to implement a more business-friendly, innovation-friendly policy, and we think that will have a positive impact for the growth outlook for the region, and we want to invest into that.
Do you feel some of that competition, though? Have you seen any of it on the ground taking place?
I mean, we've been investing in Europe for decades, right? And Europe is very different compared to the US. Many different languages being spoken, different ways of doing business, and so we have an organization with hundreds of investment professionals on the ground across all of the major economies in Europe. So we think we're really well positioned to source the most attractive opportunities in that part of the world, and to maybe use some of the inefficiencies that you have in Europe to continue to create attractive returns for investors.
Feels like a very polite way to say we have the edge over them. Okay, I'll say it, you don't have to say it, Per.
Yeah, thanks.
In terms of other opportunities, you have talked about the opportunity in secondaries, and there's been reporting that those conversations have gotten really real. Are you looking at maybe adding a secondaries business via acquisition?
So the journey that we're on at EQT is that we really want to build the most attractive client-centric scaled platform in the industry. And to be able to do that, we think we need to be world-class at deal making, value creation across everything we do, but also in terms of our client solutions capabilities, right? And we have said publicly that in that part of our organization, we want to make investments going forward, because we see investor demand to engage with us so that we can help them, rebalance their portfolios. And so that is an area that we're looking at and that we want to invest into, either organically or through acquisitions.
What about private credit? EQT famously sold their private credit business in 2020 to Bridgepoint. Would you ever get back into that?
I'd say that you should never say never, but in the near term, I say we have other more important strategic priorities for us, and I don't really see us re-entering credit, in the very near term.
So taking a big step back, you are easily the second largest fund when it comes to at least capital raise. So you have an excellent view on this industry as a whole. It is this moment where the claim goes that the industry as a whole overinvested in 2021, and now exits are difficult to come by. Is it a moment of angst for private equity right now?
So private equity and private markets has always been a cyclical growth industry, right? And it's true that post-pandemic we saw interest rates normalize and a slowdown in deal activity, and that also put pressure on distributions. What we're seeing now, though, is real signs of a potential pickup in deal activity. There's been a number of successful sponsor-backed large IPOs that have been done both here in the US and also in Europe. And at EQT, we're just focused on making sure that our portfolio companies are, IPO ready, so that we can always maximize exit optionality and really produce the best possible outcomes for investors.
It does feel like this dichotomy, because you have you and some of your larger peers of the world able to do exits, able to fundraise, and then you hear these stories of maybe mid-market or smaller funds that aren't able to fundraise as robustly. Is there a real split happening right now?
I mean, if you take a step back and look at the private markets industry as a whole, there's a number of strong forces really shaping the industry right now. And to be able to navigate this environment, we believe that you need to have scale, you need to have the resources to invest into those capabilities, whether it's AI, whether it's private wealth. And so that's also what you're seeing, I think, in some of the fundraisers, right? The platforms that continue to perform, continue to deliver for clients, for investors, those are the ones that also continue to have successful fundraisers.
EQT CEO Franzen speaking with me there earlier ahead of the company's investor day here in New York City. Those are the private markets, but to the public markets, it's a slew of outlook hikes this morning that provided an upbeat picture of the U.S. economy, despite the fact we haven't had any official government data. Michael Ball, Bloomberg macro strategist, joins us now. Michael, still early days of this earnings season, but be it Coke, GM, GE, the results feel very robust.
Yeah, I mean, the bar was low, and we're doing quite well. I think it's piggybacking off of the larger banks last week, which showed that the consumer was still in a decent place, the household balance sheet was still there. And the regionals also kind of reiterated that view in the earlier part of this week and last week. And now here we go. We got some consumer-facing companies that are, again, showing they're able to hold pricing power, hold margins, while consumers also actually moving out and sort of showing some resilience.
And there's some real trends they're capitalizing on. We were talking about this in the break, the fact that both Coca-Cola and Philip Morris were like, there are healthier trends that we're trying to pick up on. Since when do we associate healthy trends with Coca-Cola and Philip Morris?
Yeah, it's unfortunate Matt Miller's not here. I know he has a big view on the American obesity, but...
A view is one way to say it. Rant is another way you could say it.
But at this show, it's interesting that they're not only keeping up with changing trends, holding pricing power because of that, but at the same time, they're navigating all the tariff worries and having some, this is why you want these corporate managements to be who they are, because they have to do a lot of things at once.
Mexican Coca-Cola for all, I guess, is the outcome of this. Michael, thank you so much for joining.
Sure.
Always too short with you. That's Bloomberg's Michael Ball. Coming up on the show, OpenAI hires former bankers to help train its AI. We're going to bring you the details. That's coming up next. You're watching Bloomberg Open Interest. OpenAI is looking to replace hours of work done by junior bankers. Sam Altman is paying former bankers $150 an hour to help train his AI platform on how to build financial models. Participants include workers from JP Morgan, Morgan Stanley, and Goldman Sachs. Sri Natarajan, Bloomberg's chief Wall Street correspondent, joins me around the desk this morning. Sri, presumably the banks are already using AI, looking at ways to do this. What seems different in this push from OpenAI?
Well, OpenAI has more resources and perhaps can pilot this faster, quicker, and better. But at the end of the day, this is in some ways the holy grail of investment banking for years. And especially if you go back to that peak mania time of 2021, when there were just so many live deals, you had an uproar across the industry, junior bankers complaining about their workload, the number of hours in a week that they were spending on just doing basic grunt work, repetitive tasks that were not really value adds, perhaps, but essential work. So if you are out there promising a solution to that, that is something that the industry will most certainly want to embrace, but could also lead to some serious change down the road. Perhaps not tomorrow or next week or next month, but in the 3 to 5 year term, you would have to fundamentally reimagine what a junior banker's role is. What associates and analysts do today might not be what they will be doing 3 to 5 years from now if this promise comes through.
The argument has always gone, though, that the grunt work is important. It teaches them skills that they carry on throughout of their career, whether it be in banks or they go to private capital or somewhere else. What could replace their work, if not the grunt work? Is there any validity to the argument that it is necessary to have people who have that experience as they go up the pipeline?
You sound like a jaded investment banker with 50 years of experience, because this is truly the feedback that we get from many senior investment banking partners, former CEOs, who say that this is a fundamental rite of passage. You need to go through this kind of work.
But I guess the thing is it just hazing, or is it valuable?
Look, there is obviously logic to the fact that there is something to the muscle memory being developed, but you can also develop skills in different ways. Instead of having to spend all your time on Excel sheets and PowerPoint presentations, you could perhaps be involved in more strategic and analytical work. You could be involved in more client engagement. And to be honest, the real breakthrough for AI would be coming up with a solution for unresponsive managers, because the hours of grunt work that junior bankers complain about is often magnified by the hours they spend waiting for feedback from senior managers, for simple changes, for this repetitive comment cycle where you wait on someone's whim, where it's your manager who wants that mythical level of perfection to hopefully please that client and win that mandate.
So I like this. It's not just the change for the junior bankers, it's change at the management level too. But if this is being implemented, what's the line in between making junior bankers more efficient and changing their job versus just getting rid of jobs?
It depends on whether you think this is a zero-sum game, right? Technology has always evolved. Does that mean that we have fewer investment bankers today than we had 30 years ago? The argument could also be that you do more with less. If you're on a team that today covers 10 companies, would you be in a position to cover 20 companies and 30 companies? That doesn't necessarily guarantee you work-life balance. That doesn't necessarily mean you'll have time to walk along the Hudson, or if you're on the West Coast, along the Embarcadero. But it could certainly mean that you could be involved in trying to pitch for more deals. So while grunt work on every single deal could go down, if you have a sadist manager, they could make you do a lot more to try and win a lot more deals.
Do you think it helps that the people working on this for OpenAI are coming from Goldman, from Morgan Stanley, that will help shape what exactly this technology will look like and what it's used for?
Absolutely. I mean, if you look at the story today that talks about this so-called Project Mercury at OpenAI, it is talking about working with these quote-unquote contractors, people who have industry experience, who are helping refine the tool. This is not outsiders coming in to disrupt the industry. This is people who worked in the industry, who know what it takes to get the work done, who are helping build this product. So there's definitely some hope that this could land in the right spot.
Sri, thank you so much for bringing us this story. Really fascinating one. That is Bloomberg's Sri Radhanajan. Now, elsewhere in banking, one thing that AI can't replace are construction workers. And JP Morgan's new global headquarters in Midtown Manhattan is officially opening. A ribbon-cutting ceremony celebrating the building's grand opening is just wrapping up. Bloomberg The Close co-host Katie Greifeld is there at 270 Park Avenue. Katie, you're there in the new shiny buildings. What do they look like? And we assume, hopefully, no cockroaches to be found.
It is big, it is grand. I have not seen any cockroaches. I will say it's a little loud. We just heard from JP Morgan CEO Jamie Dimon wrapping up, and he opened his speech with a reflection. You think about the office building that did stand here at 270 Park. JP Morgan actually demolished that building to build this one. That was the largest U.S. building to ever voluntarily be demolished. Now we stand in the lobby of 270 Park, just opening a construction project that actually finished on time, which is a feat in and of itself. But all told, this will house about 10,000 JP Morgan employees. It will have 60 stories, and it will also have a pub on the 13th floor that is called Morgan's. And it comes at a really interesting moment for New York City. We also heard, of course, from New York Governor Kathy Hochul, but we're just weeks away, of course, from the city's mayoral election. And here comes JP Morgan with this renewed commitment to New York City.
How much of this is also a commitment and maybe even a call and a demand that you need to get into the office, Katie? If it has a gym, if it has a pub, if it has restaurants, it seems like you could live your life in the new JP Morgan headquarters.
And I don't think Jamie Dimon would necessarily be opposed to that. I will say that this building, it took 6 years to build, $4 billion. And we know that JP Morgan moved back to being 5 days a week in the office earlier this year. So the marching orders are clear here. And you think about the really commitment to this block. It's not just 270 Park. JP Morgan, its temporary quarters has been in 383 Madison, which is actually right across the street. Now they plan to spend $1 billion renovating that building as well. That will open in 2027. So 5 days a week in the office. And you think about the corporate workers that JP Morgan has in New York City, more than 17,000 corporate workers all in the office 5 days a week.
All right, Katie, thank you so much for your reporting. Katie Greifeld there at the new JP Morgan headquarters with music booming and celebrations abound with that new big shiny building, the statue, the dedication to Jamie Dimon himself. Coming up, Warner Brothers Discovery announces a strategic review of its assets. We take a look at that next, plus more earnings on dock today, including Netflix. All that to come. You're watching Bloomberg Open Interest. Warner Brothers Discovery is evaluating its future. The company announced a strategic review of its assets, and it has received unsolicited interest from multiple parties. Joining us now is Geetha Raghunathan, Bloomberg Intelligence media analyst. Geetha, it's a who's who of might be bidding for this thing, from Comcast to Netflix to others. Is there anyone who's currently not bidding for Warner Brothers Discovery?
Yeah, that's the big question, Dani. I mean, this has been now an ongoing saga that started almost a month ago with Paramount kind of first expressing interest. And it looks like, I mean, this is just from reporting literally a few minutes ago, suggesting that Paramount had made several bids for Warner Brothers Discovery, all of which have been rejected. So this is really Warner Brothers Discovery kind of trying to get the maximum possible price for its assets. They do have top tier assets, especially their studio and streaming division. The problem for them has always been their TV networks division, which again, they are planning to separate that out, both the studio as well as the TV networks by mid-2026. But now they have this alternative structure, which allows somebody to just bid for the streaming and studio. And I think they're really hoping that that kind of gets this bidding war, if you will, going.
What would be the difference, just based off of the streaming assets versus linear TV? What would the difference between a Netflix bidder versus a Paramount Skydance look like? Is there any that is a more natural fit to absorb this company?
So if it's for the entire company, Dani, it would definitely be a Paramount or a Comcast, because they do have, a whole lot of exposure to the linear TV business. Paramount, for instance, has almost 50 to 55% of its revenue coming from linear TV. So Warner Brothers in its entirety would make complete strategic as well as economic sense for Paramount. For Netflix, on the other hand, they really have no exposure to the old traditional media world of TV assets. For them, streaming and studio would make a lot of sense. I mean, Warner does have very good content, some of the crown jewels here in the media business. But again, we've seen time and again with Netflix that they really don't need to make that big acquisition. We've seen them, win the streaming wars, if you will, just with the content strategy that they have right now. So it remains to be seen exactly what they do. But obviously the news today kind of getting, I think, everybody going in terms of the M&A interest.
Geetha, just quickly, we're also going to get earnings from Netflix after the bell. What are you looking out for?
So we're definitely looking for, they're no longer disclosing subscriber metrics, but we're looking for revenue growth numbers, which should be pretty strong, high teens, any guidance that they can offer, both in terms of 4Q as well as the new number, which would be for 2026. Again, we're looking for strong revenue growth, operating margin guidance, as well as any disclosure on their ad metrics.
Geetha, thank you so much. We look forward to catching up with you after those earnings too. Geetha Raghunathan of Bloomberg Intelligence. And a quick check at your gold and silver markets this morning. Gold at the bottom down 5.4%. Silver, for its part, cratering down 8%. At one point was down 8.7%. It'd be the biggest drop since 2021. For gold, it's on track for its biggest drop since 2013 after hitting all-time highs yesterday. It is extreme volatility in these markets, volatility in gold, which is not matched by the overall market. Equities looking at trying to post another all-time high. We're about 0.2% away from another all-time high for the S&P 500, with the NASDAQ slightly weaker. Yields, those are coming down, so all of the drama happening in precious metals. Coming up on tomorrow's show, Robert Fishman of MoffettNathanson following Netflix earnings. Plus, we'll speak with Dana Dioria of Envestnet and the CEO of Workday. Those conversations coming up again on a day where it's the precious metals that are volatile and an overall equity market which tries to hit all-time highs after David Herro on this program saying it is momentum chasing that will reverse. You're watching Bloomberg TV, and we'll see you tomorrow on Open Interest.